Welcome. I've been involved in trading the markets since the early 1980s. And during this time, I have developed many tools, and all of them have shaped the skill set that I use to trade the markets today. And it's what I show in the trading room every day. As the trading days unfold, we cover lots of topics. We cover technical analysis, the evaluation of the trend. We cover our pivot areas. We cover entry points, exits. We experience our trades both profitable and not profitable when we get stopped out. But of all the topics that I can think of, if I had to pick just one thing, the most important thing that I could share, it would be what I'm about to show you now. Since early on, I have always recorded and analyzed my trading performance on a daily basis, and it is something that I continue to use today. I started using Lotus 123 back in the early 80s. I use Microsoft Excel now, and I'm showing you an example of what I do and how I use it. Whenever I had made a change to my trading approach, whenever I added an indicator or trading system, or when I traded a different market, I always took a period of at least 30 days to trade on a hypothetical basis so that I could evaluate my performance and prove to myself that this is something that I wanted to do for my account and for the money that I had deposited into my account. So what I'm showing here is a beginning balance of 10,000. It's a hypothetical amount of money that I would start with, and then I would plot the effect of that daily performance on this account balance, whether it raised it or it went backward with a daily loss. And I would plot those results. And so what I'm showing here with this blue line is the effect of my trading on this initial account balance, the daily balance of my trading. This would give me a picture of my performance, and I could determine over a period of time whether or not I wanted to place a risk with my money in real time. And so when I would begin trading with real dollars in my account, I would establish a stop line, a governor, and I would keep it pretty tight so that as the days unfolded and as I would continue to plot my results, whether they were actual or in simulation, I would know how I was doing. And as long as my performance was above this governor line, was above the stop line, I would continue to trade my actual account, real time with real money. If my performance would ever duck below the stop line, that was my indication that I needed to stop. I needed to continue trading, perfect my trading, and make whatever changes or adjustments that I needed to make in simulation, so that when my performance began to plot above the stop line, I would restart with actual dollars in my account and continue forward. This stop line then was the mechanism in which I would make adjustments to my trading approach. And when these adjustments proved to be positive, I would then re-enter with my actual accounts and continue forward. Any markets that I trade, any adjustments that I trade, I use this technique to evaluate whether or not I want to continue on with it. It is the reason why I trade the euro. I have tested my methods on crude oil, the S&P 500, the euro, and by using this tool, I've been able to demonstrate for myself that it is the euro that I want to trade.